All right, I have hit the record button and I officially welcome you to the Option Trading Made Simple live Q&A call. And what I'm going to do, the agenda for tonight is we're going to cover a few admin notes real quick. Then I'll cover the basic concepts of the book, my newest book I came out. That's the purpose of this webinar for those who don't know. I wrote a new book, and so I wanted to do a webinar to kind of walk people through a live example of the concepts taught in the book, and also a live example of the trade, so that way different people learn in different ways. Some people like reading, some people like watching live calls and things like that. So that's the purpose of tonight's webinar. So we're going to cover some of the basic concepts in that book. Then I'll walk you through the actual strategy taught in that book, and then update you on the trade. I actually made a trade based on that, the concepts taught in the book, and then we'll end with some Q&A. Now, the first admin note is that all of my training is for beginners or those who have yet to be consistently profitable. So I always tell people, if you're already familiar with option basics or you're an advanced trader, you just have to be patient, because my heart is for people who used to be where I was at, who don't know anything about options and they need it broken down and simplified. And so that's my style. So sometimes I attract more experienced traders, but for the most part, they are usually bored with my teaching style because it's really simple. So if you fit in that group, I just say, please be patient. Again, my heart and I cater to beginners, and so that's the way I teach. So this call may just be a brief overview for you. You may not find that much value, but you never know. A review of the basics never hurt anybody ever. At least all the successful traders I know will confirm that. Also, the focus of all of my training is on real-world implementation, and moving forward in the next few years, I'm going to be even more strict with that. Usually, I found that people will get used to watching videos and reading books, but they won't take action. And so my goal moving forward here is to really get people to take action, because that's where the real learning takes place. As when you implement, you learn. Don't think that you have to learn everything about options before you can take action. That's totally not true. I made, not to brag, but I think the first year I made somewhere, I think over 20 grand in profits. I had no clue what the heck I was doing, literally clueless. But I knew a few basic concepts, buy and sell and things like that. And I'm teaching my students the same way. I'm like, just get out there. Learn, get a good enough understanding, get out there, take action, and then we tweak and fine tune along the way. And so that's where a lot of my focus is, which is why the book is so short and has a strategy at the end to get people to take action. And tonight, what I'm going to do is teach and then take occasional breaks, maybe every 20 minutes or so, to answer questions. If you have a question, you can hold it to the end. I'll have a Q&A session at the end. Or if you just think you'll forget it, go ahead and type it in as I'm talking, and then when I take a break, I'll kind of scroll through the question panel to answer your question. There will be recordings available. They take about 48 hours to edit down and post to the website. So it'll be available roughly 48 hours after this call, and it will be posted to this website. I don't know if you can see the link. You probably can't see the link at the top right of my screen, but either way, I'll send you a link to that, and it'll be posted right below, right beside this video here. This is just a short video instructions I wrote to walk people through the strategy in the book. So anyway, I'll post it to this website and give you the link, and it takes, again, roughly 48 hours after the call. So just be a little patient with the video editor there. And disclaimer, if you're on this webinar, if you got one of my recent emails, I sent people on a treasure hunt, and I say, hey, I wrote a new book, and to reward people for reading it, I want to see if you can find 2 errors I intentionally placed. There were more than 2. There were like 10 to 15, I think. Most of them I knew about. A couple I didn't know about. But one guy was like, there's more than 2 errors. I was like, yeah, I know that. But if you think I tell people there are 10 errors, go find them, they're going to actually read it. No. So I figured, well, if I just give them 2, people will find 2 and stop, but they will engage in it, because my goal is to get people to engage, to actually read the book and implement the strategy, because I want you to have results fairly quickly. So that's why I only put 2 errors, go find 2 errors. But in full disclosure, there was actually more than 2 errors. So I thank everybody for taking the time to give me feedback on the book if you read it, and also taking time to join the webinar. My mentor always taught me, well, mentors always taught me that time is your most valuable asset. You can get back money that's lost, but if you lose time, you can't get back tomorrow. If we wasted our day today, we can't get that back. So, time is actually your most valuable asset. And so, you should always look to, protect that asset at all costs, and make sure you don't, have people waste your time and things like that. So with that being said, I recognize that you showing up tonight, even people watching your webinar, for those who don't watch the replay, you even watching the replay and taking time out your day to watch it, I am completely honored. I'm humbled, and I really want to thank you and let you know that I don't take that lightly. I recognize there could be a million other things you could be doing, but you're taking the time to allow me to tithe into your life with this knowledge. And so I just want to thank you for that. So real quick, I want to cover some benefits of options trading if you are not aware, so you can understand why I'm so excited about teaching this and why I actually decided to share this knowledge, because I believe that all good things are meant to be shared. And one of the benefits, the major benefit, I guess the overall benefit a lot of people are attracted is because stock options allow you to make money when the stock market is going up, down, or sideways. A lot of us, traditional, I come from the traditional investing, field where I just bought stocks or mutual funds, and I only made money when everything went up. Everything was great. But it was when stocks started crashing in price, I was losing like 20, 30%. I was told just sit tight. It happens to everybody. It'll come back. Pretty much there's nothing you can do. And, once I learned options, I was pretty upset that nobody ever said, well, you could protect yourself with a, protective put or stock option. You can actually make money when, the market is going down. No one ever told me that. So when my mentor, taught me all this, I was, one, a little skeptical. It sounded too good to be true. But two, on the other side of that, I was relieved to know that for the rest of my life, I have no more financial worries as far as what the stock market is doing. No matter what it is doing, there is a strategy or a way I can go in and make a profit. So it allows me to stay in the market pretty much at, any given time. And most people are losing money during market crashes, and so we are still able to make money. So it accelerates your wealth building and your wealth creation. And if you're, retiring, you really don't have to stress when we have another market crash because you are good to go. Another benefit is you can benefit from a rise or fall in the stock price without actually owning the stock. And so a lot of people are watching Facebook or Apple nowadays, and they think Apple will go up, but Apple, maybe they didn't have the money to buy Apple stock. Well, you can buy an option and still benefit from either rise or fall of that stock, and you don't even actually have to outlay the 10 grand plus to buy shares of that stock. You can position yourself in a big move in the stock even if you don't know which way prices will go. So pulling up a stock chart here, I use Thinkorswim as my broker. We may not come to my broker screen that much because the book is based on teaching people who don't have a platform. But real quick, I just wanted to pop up Twitter. Let's say you were following Twitter. Twitter had company earnings recently. And what if you wanted to speculate or gamble, that Twitter would go up or crash down in price? Well, there's a strategy where you can actually position yourself to make money no matter which way it goes. It's called a straddle or a strangle. And so that's the strategy we use. I don't use it a whole lot anymore. I don't trade earnings a whole lot anymore, but that's one of the strategies you can use. You can earn extra income off current stock holdings. So if you inherited some IBM stock or stock from your company, I have a student who has stock in Home Depot. That's where he works. It's somewhat like renting out your stock, sort of like people rent out their houses for monthly income. Well, it's like renting out your stock. You can take your current stock holdings and sell things called covered calls, and usually can earn, anywhere from 2 to 5% a month. It's usually on the lower end, about 2 to 3, but in a good time period, you can inch up to 5% a month. But let's just say conservative. So you could, sell some covered calls and each month, collect about 2% extra percent in cash, and that ranges depending on how much stock you have. But so it's a good way to just earn extra income off of stocks you're currently holding anyway. A lot of people don't know that's possible. And the last, one of the last benefits is something Warren Buffett does. He uses options, or a lot of people use options to buy stocks at a lower price than everybody else. And that's called cash secured puts, if you're wondering what that strategy is called. A lot of people will do this. Stocks they want to own, you can come in and use options to actually buy it at a lower price. Get paid to actually buy stock you want to own. It's one of the coolest things ever. And it's like, it sounds too good to be true. You're going to be pinching yourself when you're doing it, but the reality is it is true, and that's just the way these contracts work. And lastly, one of my favorites is that you can guarantee you won't lose money if your stock declines in price, and that's called a protective put option. So if I was to come in and buy Apple Computer here, Apple Computer is currently trading at $126, and let's say I bought some shares of Apple, but like anybody, I don't want to lose money. So I could come to the option chain and buy something called a protective put around this price level. Now that insurance, it's stock insurance. And actually, it's what options were originally created for. They were created for a hedge or a stock insurance. Another way to say that is just insurance for stock traders or mutual fund traders. So I could come in and buy this put option around this price level, and it's insurance. It's going to cost some money, but it will also assure me that I will either won't lose money or only will lose a set amount of money. And again, with insurance, it's a premium, but I'm like, well, yeah, it's going to cost me money to buy that option, but look at how much money it's saving you and protecting you from. Sort of like an example we're going to cover in a little bit later, my house insurance. Yeah, I may not like writing $90, checks each month to an insurance company, but if the 200 grand house burns down, I'm going to think those $90 was a bargain, because the insurance company is going to come in and pay money to help me so I can build a new house, essentially. Now, real quick, I'm going to take like 30 seconds to walk you through my story case for those who, I don't know if you're new to my story or anything like that, but I grew up in a small town in Virginia, and we grew up what you would call American poor. It's not like third world country poor, but the house I originally lived in had no running water or bathroom, and we actually had a bucket that we would put in our back room, and that was our toilet. And that's what we use at night or during the winter. And during the day, we would come out to something called an outhouse. And unless you live in a country, you don't even know what an outhouse is or have seen one, but that's what we use as a toilet. We had an outside toilet and then an inside toilet. The inside toilet was a 5-gallon paint bucket. So that was my childhood. So needless to say that, I didn't know anything about investing. I was actually, I guess brainwashed to believe that all rich people were evil and greedy. So I was always a little skeptical and bitter towards rich people, thinking that they were out to take advantage of all of us, which I found out was completely wrong. But, as part, whatever you want to call it, God's favor or luck, when I got older, like most people, I went to work, sick of work. I'm on the internet, like, I need to find another job. I need to find another way to make money. And I don't know how I discovered it. I landed on some website, and it was, these guys saying, hey, we'll teach you the secrets to how we built our fortunes. Fill out this application. I filled out an application. They interviewed me, and then they invited me to join, I think it was called the Enlightened Millionaire Institute or something like that. And so it was a bunch of millionaires, and what they were doing was teaching everybody how they built their fortunes. And one of the things I learned was options trading. Now, it's just one. They taught several different things: real estate investing, how to write books, how to create internet businesses. It was mainly, the premise was multiple streams of income. A lot of people think that options is my only source of income, and that's a wrong assumption, because I don't ever say that anywhere. And it's not. We have, I think, maybe 10 sources of income. And the reason why is because my mentor told me that relying on one source of income, whether it's real estate investing or options income, it's not smart. It's no more, it's just as not smart as having a job is your only source of income. And then you get laid off, you recognize how flawed that plan is. And people are stressed when they get laid off because they're like, they have no other source of income. So my mentors was always like, okay, what if your options income dries up? Like mine dried up last year. I made just a tiny bit of money, and this year I'm not finding that many trades. He says, so, okay, what you want to do is have another source of income to compensate. So we have rental properties. So I'll take my option income. We'll go look for real estate and rental properties and things like that. I'll do consulting in town for small businesses. People will invite me to speak and different things like that. And so, I'm following the blueprint my mentors gave me to develop multiple streams of income. It's just that options is my favorite. It's the one I like. It's the one I make the highest % return on investment. No other source of income even come close to what I make with options. So that's why you mainly only hear me talk about options and why I teach that. It's just my favorite source of income, but it's definitely not my only source of income. It's just not what my mentors taught me to do. And so I took what they taught me and kind of adapted it to options, and we call it the option profit formula. And so the way they told us to do it is just take any source of income and we buy or accumulate assets. So, one of my rental properties is an asset, and then it just, spews off monthly income. So the goal is he said, not to be a net asset value investor, meaning that I don't want to take 200 and turn it into $1 million. What I want to do is take 200 and turn it into $500 to $1,000 a month in monthly income. Because if I take 200, let's say I buy a property, let's use the exact example they gave me. If I buy a property and I was a flipper, if I bought a property, for 100 grand, my goal is not to buy in an area so that property is worth 200-300 grand down the line in a few years. It doesn't matter, because in order for me to reach that income, I've got to sell a house or things like that. So they said always structure our portfolio to spew off monthly income. Everything we do, look to see how much monthly income it will provide right now. Not in the future, but right now. So that's what they taught us to do. So with that being said, let's go ahead and cover some of the option basics, and then I will walk you through the strategy taught in this book here. And for those who showed up a little late, again, the purpose of this webinar is just to kind of walk people through the concepts taught in my newest book. And then after I walk you through some of the basic concepts, then we're going to walk through the strategy taught in this book. And then at the end, I'll update you on a trade I placed based on that strategy. And then we will have some open Q&A. If you have questions while I'm talking, you can type them in. There should be like a little box in the top right of your screen where you can type in questions. And then when I get to a point, I will stop and answer your questions. All right. So as explained in the book, there are two camps or approaches to trading options. You can be an option buyer or an option seller. Now, option selling is not covered in the book. I wanted to cover it just to touch on it a little bit here on the webinar so you can kind of understand what it's about, and then we'll talk about option buying, which the book focuses on. Option selling is unique, and the reason I didn't talk about it in the first book is because the basic principle behind it is you're selling something you don't own, and you're getting cash for it. All right. So imagine me, let's say you owned a house. Imagine me selling your house on the market and then walking away with the profit. It's not even my house, but I'm selling your house and walking away with the profit. I don't even think you would like that. But, that's kind of how I look at option selling. It's not quite like that example, but what it is like is something you're probably already familiar with. And it's what I talked about earlier, like insurance. If you have car or house insurance. So right now you are paying car or house insurance. You're writing premiums. You're sending money to your insurance company each month. And the reason you're doing that, excuse me, and the reason you're doing that is, if you wreck your car, the insurance company will come in and fix your car or buy your new car. Same with your house. Your house burns down, your insurance company will come in, give you money to buy a new house. So you are paying the monthly premiums in exchange for them taking on the risk, of paying you a lump sum of an accident happening or something like that. All right. That's what option selling is essentially like. You may not like writing, sending monthly premiums to your insurance company, but if there's an accident, you're going to be glad that you have insurance. And you talk to anybody who had an accident, they are glad they have insurance. So again, I said that you go in and you sell something you don't own. So right now, I don't think I have any. I have a couple of trades in this account. But right now, let's say we're looking at, again, Apple Computer here. This 125 put option right here. I do not own this. I haven't bought it. It's not in my account anywhere. So it is literally not mine. I don't own this at all. But if I come in and I click this bid price here, if I left click on it in my broker platform, hit confirm and send, you will see that it will show max profit $430. So I'm clicking this button. I'm going to sell something I don't own, and $430 will immediately show up in my account. The reason why is like the insurance company. This put option, when I sell this, what I am saying is I am willing to take on the risk of buying Apple stock if, in the next, if it's close to this $125 price level in 64 days from now. Then, if the stock is trading around this price level in 64 days, I would have to buy Apple stock. Sort of like your insurance company. If there is an accident, they would have to give you money to rebuild your house or buy your new car. So I am taking on some risk here. In exchange for that risk, I'm receiving a premium, the same premium you send to your insurance company. So when you're an option seller, you are essentially being like an insurance company. And so that's why people like option selling, and for various reasons, things like that. So that's just a brief overview of option selling. Again, I don't really cover it in the book. I do teach it in our advanced program, the Success Academy, and in the next few series in the book series, because this is volume 1. I want to have several volumes, and one of the later volumes I want to go ahead and kind of touch on option selling a little bit, because I think it's pretty important. It's one of the main ways we actually earn monthly income because of, again, like your insurance company. That's, if you go to a city, the people who have the biggest buildings, it's a joke to say the people who have the biggest buildings are banks and insurance companies. And it's because it's a very profitable business, because how often do you have a wreck or your house burned down or something like that. So option selling works like that. There are a lot of times you will month in, month out collect premiums for taking on risk, and it's rare if, ever that you will have to cough up all of that money. It does happen, but, it doesn't happen that often. Okay, now option buying. Now option buying is what you already know, buy low, sell high. And the two examples I have, let's imagine options. Here's a side note. Options can be, in my opinion, pretty hard to learn and understand unless the way I teach and the way I was able to understand options was I had to relate it to something we understand, analogies. We have to relate it to something we understand, and then we take that understanding back over to options and kind of tie it in. So the two examples I have for you tonight is a rare baseball card. Why would somebody buy a rare baseball card? Well, maybe for a collection, or because they think it's going to go up in value one day, and maybe they hope to sell it. So they're going to buy an asset, hope the asset goes up in value. They're going to wind up selling it later down the road. Another example is raw land. Let's say you were able to buy this raw land here, this oceanfront piece of land right here, maybe build a house on it one day, or regardless, just buy it and don't do anything with it. Well, is one of the sayings they say, well, God's not making any more land. And so land is one of the only things that continuously goes up because the supply is limited, but the demand increases over time. And the demand for oceanfront properties or beachfront, whatever waterfront properties will increase definitely over time because the supply is limited and is decreasing over time. So it's always going to increase. All right, so you buy a piece of land, especially waterfront, over time is going to go up in value, and then you can sell it for a higher price. That's exactly how option buying works. So now let's tie it back into options. And so just to make sure you guys are still awake, guys and gals, make sure you're still awake. I want you all to give me 3 stocks. First, people who type in, you can give me the stock symbol, the stock name. We're going to look up 3 stocks that you think will go up in price here next 6 months to a year. Okay. AAL, let's see, Cisco. I don't know the stock price of Cisco. Let's see if we can find Cisco. If you know the stock price of Cisco, CI. Okay, got it. Okay, CI. Is it AAL and then CI, Cisco? Anybody else? I need one more. So let's go ahead and pull up AAL real quick and make sure I got your right stock. I don't know if you meant Apple or not. So American Group, HAR. And people are, all right, so y'all can go ahead and stop putting in. I only need 3. All right. So Brian says no, American Airlines. All right, Brian. Okay, American Airlines. All right, great. So let's pull up a 1-year chart of American Airlines, stock symbol AAL. So this is a 1-year stock chart of AAL. All right, so for the year, it's gone up. It had some stagnation here, or it had a drop in price, a pretty severe drop in price. Almost looks like it's like 50% drop in price here mid-year there. But, it's been going up for the year, been going down recently. Okay, so that's AAL. All right, so let me make sure everybody can see that. Yep, you can see that. Okay, let's pull up the stock chart of CI, because what we're going to do is instead of just teaching you examples, we're going to actually track this after this webinar. CI, okay, that's the chart of CI, Cigna Corporation. I like this chart better than AAL's, American Airlines. CI, the story, every stock has a story. The story is telling me that it's gone up for the year, and it's pretty healthy. It hasn't been any severe pullbacks like it has here with American Airlines. But American Airlines is higher than it was a year ago, so we can't discredit it. But I do like the chart of CI better. So now let's look up Harman International. This one stayed flat for about a year. And, you know, it recently had a pop-up in price because of earnings here. You can see this little phone and dollar sign had a pop-up in price because of earnings. But other than that, it really stayed stagnant for a year. And then we have Apple. All right. So out of all those charts we just showed you, let's pick two. So here's a chart of Apple. Here's a chart of HAR. Here's a chart of Cigna. And here's a chart of American Airlines. Pick your favorite two. What we're going to do is track these. Because again, the examples I just gave you, buy a baseball card, buy raw land, you think it's going to go up. What we're going to do is actually look up the stock prices, option prices, and we're going to actually track these ones here in the next few weeks for you. So go ahead and type in which of your two you liked. AAL, again, AAL. We have CI. Let's pull up CI again. I know which two I like. Here's a chart of, give us 1 sec to update. Here's a chart of CI. Here's a chart of HAR. And lastly, here's a chart of Apple. Okay, so it looks like we are mixed here. So it looks like CI and Apple was the first vote, CI, HAR, and people were picking their picks. Okay, so how about we'll do this? I'll be fair. CI, we'll track CI, Apple, and AAL was the last one. Somebody put in, you were first to put it in. CI and Apple had 2 votes, so we'll definitely leave CI and Apple in there. But we're going to look up CI, Apple, and AAL. Okay, so let's come to the option chain here, and I have spreadsheet pulled up here. We're going to cover my trades here up here. We're going to update it here in a second. So again, buying raw land, buying a rare baseball card, you think the asset's going up in value. So let's actually put it to the test and actually simulate buying an option. Excuse me, my throat's a little scratchy tonight. So we're going to actually type in CI was the first stock, Apple was the second stock, and HAR. All right, so let's go here to my broker platform again. Apple Computer closed at 126.46 today, and this spreadsheet here is actually on that web page where the webinar is going to be posted. It's called the Trade Tracker. Let's pull up that website again. You can see up here the link to the ebook and the Trade Tracker. This Trade Tracker is actually right there on that web page, so you will see that, and I will actually upload this updated version. Excuse me. All right. So keeping with the theme of the book, we were looking at options that expired roughly a year out. Okay. So it's February now, so we will be looking for February 2016 options. We don't have that here for Apple. There is no February 2016. I said, well, if you don't see it, I said, go out the next month out. Well, they don't have a next month out. It's January 2017. So for this, we're just going to pick January 2016 because there's no other month. And again, per the strategy taught in the book here, it's towards the end. I told you all to look at the at-the-money option just to keep things simple. At-the-money option means that it's the option that is trading closest to what the stock is trading at. So the stock is trading at 126.46. So for this purpose of this exercise, the at-the-money option, it looks like it's going to be this 125.71. That's the one closest to where the stock is trading at. So 125.71 call option here. So we're going to simulate buying a January 2016 175. What is it? What is it again? I just forgot already. 125.71. Wow, I was way off. 125.71. Okay, for the price of, we buy at the ask, sell at the bid. I confused some people in the book. I've since simplified it. If you were to buy an option, you buy at the ask price. When you go to sell, you generally sell at the bid price. Okay, it's like an auction. So we're going to buy at this ask price, $13.35. 1335 always has to be multiplied by 100 because this one option contract right here represents 100 shares of a company stock. All right. So I've already have the spreadsheet here. Apple is trading at 126.46. If we bought 100 shares of Apple stock, it would cost us $12,000. This is one of the benefits of options. A lot of people don't have 12 grand to invest in stocks, but they can simulate the same 100 share ownership with the option contract. And so they will come in, buy one contract, and it only costs $1,300. Okay. So we just simulated buying both 100 shares of Apple Computer at this price, and we simulated buying this option contract at this price. Okay. And I just have here my commissions what my broker charges me. Well, they charge me a little bit less, but for most brokers it's somewhere around here. Okay. So before I move on to CI, does that make sense? Did I lose anybody there? We're really only looking up the stock price. We looked up the option price and we simulated buying. Did that make sense to everybody before I move on? I'll go ahead and keep typing in these numbers here for CI while I wait for your response. So 114.91 is where CI is trading at today. And let's look at the option here. Okay, so it makes sense to at least one person. That's Dwayne. Thanks, Dwayne. Okay, so again, same here. We don't have any other months. We just see January 16. So January 16, 110 call option for 1370. So let's go ahead and simulate buying that, 1370. And we're buying the January 16, 110 call option. All right. So now let's move on. What was the last one? AAL. So AAL, and I'll double check my numbers here after the call. You know, if I make a typo or something. HAR. Sorry, was it HAR? Should have been AAL was the last one. No, HAR. Yep, it was HAR. So we will stick with HAR. So HAR is trading at 47.88. So we'll go ahead and simulate buying 100 shares there. The reason I'm doing this, simulating buying 100 shares, is what I have up here. I want to show you the comparison, 100 shares of stock versus one option contract. So that's what I'm doing here. That's why I have 100 shares of stock there, because I want to simulate and show you what's the difference there of buying 100 shares of stocks versus one option contract. So we're picking the January 1645 call option here for 945. Right, so 945. January 1646 call, I believe it was. 45 call. Okay, so 45 call. So what we're going to do is over the next few weeks, you're going to track this yourself. I'm going to upload this spreadsheet to the website, and if I have another webinar, which most likely I will, when I have another webinar, you know, I will update everybody on these results. Again, you can do this yourself over the next few days or weeks, but using purely the bid price. Okay, we bought at the ask. So when you come in and you want to see how it's performing, you look up the bid price. So we bought this January 45 call option here, January 16, 2016, 45 call option on AAL. I looked up AAL. We're just going to go with AAR. So forgive me for whoever gave me HAR. All this was for AAL. So without going in and retyping everything, we're just going to roll with AAR for now. So anyway, so next week or a week from now, if you want to come in and check this, you would log down the bid price here at the current price. Let's say a week from now, the bid price is at $8. You would type in $8 and you will see that you've lost $159 or 16% return on your money. Okay, so that's what we're going to do there as a live example of trading options. All right. So somebody's typing in, you have to take round trip commissions. Yeah, you would if you were to sell, but for these we're not selling. We're just tracking them. So if we were to actually sell, then yeah, we increase. If I was to actually sell, I'd put in another column here. But for this, no, we're just tracking it. We're not selling it. So a good point, though. All right, so let's go ahead and move on back to this example here, because I'm going to walk you through a trade here. Real quick, though, just to give you some of the basic concepts of options. Right here, we bought for AAL, since we're right here on AAL, we bought the January 2016 45 call option here. So coming here to this spreadsheet, let me give you some of the basic definitions of options. First, I cheated here by went ahead and just bought a call option without asking you. In the book, I teach you that call options go up in value when stocks go up. Put options go up in value when stocks fall. So AAL was one of the stocks we looked at, and AAL has been going up for a year. So I had planned on asking you, should I buy a call or put? But I know most of you will say a call option based on the basic definition. So we look at the stock. What is it doing? Is it going up or going down? Well, it's going up. So what do we use to profit when stocks go up? We use call options. Well, one of the strategies is we buy calls. So we bought a call option here. Okay. Now the rights, options give you rights. When you're an option buyer, you have rights. Option sellers, you have obligations. Remember, an insurance company is obligated to pay you cash if your house burns down. Well, as an option buyer, we don't have those kind of obligations. We aren't obligated to do anything, but we do have rights. So this option we bought right here gives us the right to buy American Airlines stock at the price of $45. $45 right here is called the strike price. That's the price you have to buy the stock at if you choose to exercise this contract. So it gives us a right to buy the stock at $45. And we have a year. It expires January 2016. When it expires, it ceases to exist. It goes bye-bye, like most contracts have an expiration date. So that's how long we have till it expires, roughly a year. To be exact, it tells you how many days here, 337 days from now. Open interest. Open interest and volume are two columns here. Open interest here, I glanced at it as I was doing this, and I know the open interest on most of these stocks are high because I'm familiar with them. Open interest here on this option we bought is 5,583. Open interest is just the number of contracts that are currently open and not closed. So if I was actually buy this in my broker platform here, or, left click on this ask price, because remember we buy at the ask, we sell at the bid. If I was to buy this, confirm and send, you will see it was going to cost me $945, and then the open interest will go up to 1. It will go up 1. So it'll be 5,584 contracts. Now, when I go sell that, if I was to sell at the bid, sell it back into the market, then it would decrease the open interest by 1. And volume is just merely, how many contracts are traded this day. Okay. So this option expires within a year. It gives us a right to buy American Airlines for $45 on or before, January 2016. Has a high open interest, in the thousands. So that means a lot of people are interested in this option. And let's talk about something called intrinsic value. Now, without getting too techie on you, let me just ask you simply. If this stock goes up, we bought a January 45, let's come to the spreadsheet, it's easier. We bought a January 45 call option, and the stock is currently at $47. If the stock goes up to $55 in price, we own a contract that says we can buy it for $45. Goes up to $55, but we have a contract that says we can buy it on sale or a discount. Now, do you think this contract will go up in value from where it's at right now? Go ahead and type in the answer, yes or no, in the question panel, webinar question panel. So Danny is saying yes. Is Danny the only one listening to me? Is everybody paying attention? All right, we got a couple of more yeses there. Yes, exactly. So going back to our land and, baseball card example, we bought an asset because we think in the future, buy low, sell high, that this asset will go up in value, or at least we hope that. Okay, so that's the exact same thing here. This asset, which is the option contract, will definitely go up in value if the stock goes up to 55. Okay, let's reverse that though. Let's say the stock goes to $43. Okay, $43 in a few weeks. Let's say the stock falls in price to $43. If you were to buy it on the open market, you buy for 43, but you bought this option contract that says you can buy for 45. Now, you can buy for 43 on the open market, or you can buy for 45 with your option contract. Do you think that if the stock goes down in value, this option contract will be worth the same price? No, it wouldn't. It would actually be worth less. So that's why in the book I tell you that when stocks go up, call option values go up, and when stocks go down, call option values go down. That's pretty simplified, but that's essentially how it works. All right. So let me take a break here. I'm going to take a sip of water and then look at a question somebody type in and make sure I'm not leaving anybody behind. Okay. So somebody says, excuse me again. Somebody says the percent change formula is wrong. Yeah, we're going to change this. It doesn't matter. After the call is where I'll go through, make sure I typed in everything okay. I don't take time to go through the formulas and stuff on a webinar because it just takes too much time. So mainly what I want to do is log the correct option prices and things like that. So I'll go through over the call, after the call, to make sure everything's correct. And then I will upload this to the website. So thanks for pointing that out. All right, and thanks, Brian, for your answer there. All right, so we just went through a live example of buying those 3 stocks. Again, we will track these, and let me update you on my trade results after I walk you through the example here in the book. So let's pull up the book. Let's increase the font a little bit for you, and let's scroll down, and let's find, we'll walk you through the strategy. I want to walk you through the strategy and then update you on the trade I placed based on this. So in this book, I actually walked you through the exact strategy I placed there. So it was 9 steps. Okay, steps 1 was go to finance.yahoo.com. I have that website pulled up here. Okay. Step 2 was to look for the quote box, which is over here to the left. Okay, and so step 2 again was to look at the quote box over here to the left. We're going to pull up a 1-year chart of SPY. So quote box is over here to the left. I'm going to pull up SPY. I'm going to hit go. I'm going to look up a 1-year chart. And then you're going to ask yourself really 2 simple questions. And I don't want you to argue with it. Don't complicate it. Don't freak out. Again, my focus, on all of my training is real world implementation. Do not let any head trash get in the way and keep you stuck. So I told everyone to ask themselves 2 simple questions, and that was, I think, step 4. Okay, step 4, we evaluate the chart. If it's been going up and still going up, we're going to buy a call option. If it's been going down and still going down. So looking at this chart, for the last year, has SPY been going up, and is it still going up? Yes or yes? Okay, Brian says yes. Okay, Michael asked a question, do I use trend lines? Yeah, absolutely. I use all kinds of trend lines, secondary indicators, but for the purpose of this book, I'm teaching people who do not have broker accounts. I'm not teaching them to be advanced option traders. It's too much. There's a lot of things you can't teach in a book. This is what I talk about in the book. It's like trying to teach brain surgery via a book. So by asking these 2 questions, is it going up, still going up? It eliminated a lot of stock chart reading, trend lines, all these indicators you would need. It really protects you from a lot of different things, and it kind of gives you some. And buying an option a year out gives you a lot of leeway to, like, looking up what stock was it? It was AAL. Let's look up AAL real quick. So buying a leap option a year out kind of protects you from, what I talked about here with American Airlines, where you have a 50% drop in the stock price. When you have an option you're holding for a year, you kind of can wait the stuff out, or it sorts itself out along the way. And also gave you some risk parameters or money management parameters to kind of protect you. So that's the secret there. This is why I have that exact strategy to pick a year out and ask those 2 simple questions, because I wanted to simplify and how to have a way that people can actually learn how to trade without learning how to, read technical indicators, moving averages, all that. Too much. A lot of people would just gloss over. They get stressed, they wouldn't implement. So I wanted to simplify and break everything down. But yes, in my real trading, absolutely, I use all that stuff. Okay, so anyway, going back here, we asked ourselves 2 questions. Is it going up, still going up? Yeah. Then we look over here to the left, we look at the option chain, and we do exactly what I just taught you a few minutes ago. We look up the leap options. So on Yahoo Finance, it just happens to be at the left over here. It has options. So we click up options, and you can, it took me a while to realize this, but you can actually filter some of these options because it shows a lot. So we're looking about a year out. And so we don't have a February 2016. So again, well, we do have a March. So if I was to do this right now today, I'd probably go out to March 2016. I've already placed a trade, but just showing you a quick example. And since it shows so many strikes here, is really congested, but we're looking for that, the money. Stock is trading at 208.92. And remember, at the money is the option strike that's closest to where the stock is trading at. So if we look at these strike prices, remember the strike price is the price that we would have to buy or sell this stock is at. And so stock is at 208. So 210 is closer to 208 than 205. So for this purpose, our at the money option is 210. And so we just write the ask price here which it looks like is 1273. So again, we would simulate buying that option. Okay, so that's the strategy I walked everybody through in the book. And then also in the book towards the bottom, I gave everybody the most simplified trade management formula I could give you as far as when do I exit and all this other stuff. And you pretty much, you don't tinker with the trade. It's going to be tempted to sell early. You're going to see some profits. But no, I want everybody to exit anytime after it hits a 50 to 100% gain range or immediately at a 40 to 50% loss. Okay. Again, looking at my trade, let's go ahead and I'm going to do a live update here of my trade. And I'll show you better what this 50% gain or loss looks like. So today is 2/12. Okay, so I bought simulated and bought 100 shares of SPY. Back here on January 23rd was the opening day. So SPY right now is, let's pull up SPY. Let's look at my broker platform, see if their prices. Yep, 208.92. Just wanted to make sure. So the stock is trading at 208.92. So the stock, I've made a profit of $390 or 1.9%. Okay. I also bought a January 205 call option and initially paid $12.09 for it. So let's go ahead and look up the January 16 205 call option here and see what that price is at now. It's at $14.34. And I'm not 14. Again, here's a mistake I always make. You have to watch me. My eyes always gravitate to the ask price. Don't ask me why. I have no clue. So sometimes I will write down the ask price and it's wrong. Remember, when you're checking to see how your trade is performing, if you were to sell this option, you always look at the bid price. So the bid price here is $13.55. So if I was to sell this option today, I would have to sell it at $13.55. So I put that here. Okay. So the stock I made $390 on, option only made $131. But look at percent wise. Okay. For the option here, I'm up 10%. And for the stock, I'm up 1.9%. Okay. Don't start drooling over that yet. So let's come back here to the losses. Okay. Over here on 129 when I updated this, and this is the 129 update is the update you see on the website here in this OT Option Trading Made Simple video instructions. I walk people through the video version of these instructions. I updated everybody to show that, hey, what you'll find in any of my programs, we don't hide losers or anything like that because it's reality. I hate when I get emails and people are always just talking about how much money they're making. I'm like, that is not realistic at all. You will definitely lose money. And sometimes you lose money more times than you care to lose. So anyway, I updated everybody. I was losing money here. So the option was losing 21%, and the stock was only losing 1.48%. 2158 divided by 1.48. So the option was losing almost 15 times more money on a percent basis versus the stock. Okay. Now moving forward here on 212, the stock is up 1.9%, but my option is up 10%. Okay. And if you do 10 to 1, so it's almost like the option made 10 times more money than, 9 to 10 times more money percent-wise than the stock. That's one of the benefits of options. It's what I talk about in the book. It's actually example, I can't remember, I think it's in chapter 1, I say that the stock may have a 1% move in price and the option will have a 10% move. A lot of people hear that. Again, it sounds too good to be true, but you're seeing this. It's literally video proof of what you're seeing. In this video I showed you, or in the book, you can see what the price of this option contract was on this date. It was $12.09. Now you're seeing here at 212 with the price is $13.55. Look at the dates. 123, I opened the trade. It's now 212. Less than a month later, it's up 10%. And that's what I was means when I said it's responsible for a 10% return on my account or trade in 1 month. But I also want to point out, look at the fluctuation here. Okay, I opened it on 123. On 129, which was like 6 days later, it was down 21%. Now it was up 10%. So it had to recover the 21% loss and then go up 10%. If you're doing your math there, that's a 30% swing in price. Okay, a 30% swing in price from down to up. This is one of the hugest reasons why newer traders struggle with options. You're not used to that. Stocks, mutual funds, you don't see that kind of fluctuation in price. And you sometimes you can't handle that stomach-wise. Like you can't handle that, seeing your account swing up and down 30% in a few weeks. And so it freaks people out. And they wind up selling too early. Like some people would freak out here. They lost 21% of their money in like 6 days. They're going to like, what the heck? And they sell. And of course, you know how it goes. You always sell and the stock goes up, which it did. And it went up to 10%. And so I try to avoid you doing all that. I know emotionally people are going to see this, freak out, sell, get scared. That's why in this book I said do not flip and tinker with the trade. Do not mess with it. Only exit and this criteria at a 40 to 50% loss or anywhere in the range of 50 to 100%. I said I would show you what I mean by that. So right now, this loss right here when I was at 21%, yeah, most people, newer traders, would be wanting to exit right there. And I'm like, no, I said anywhere 40 to 50%. So let's say the stock went to $5. That's 59%. That's way past my 50% range. I would exit. Okay. Hopefully you catch it before it hit 59%. Maybe you catch it when it's at $70 and you exit. But that's what I mean. When it hits around 40 to 50%, you would exit. Now, on the profit side, anytime after 50%, but before 100. So that range. Okay. So coming here, we're up 10% now. Let's say the stock went up to 15%. We're making $15, excuse me, up 22%. Let's go up to $20. We're up 64%. So it's past 50, it's below 100. So I have a choice at this point. I can exit now, or I can be a little greedy or risky, however you want to call it, and I can let's see how far I can go. And then it goes 105. Then at that point, I'm like, yeah, let me go ahead and exit per the rules that Travis gave me. And then when you exit, you just rinse and repeat. You go back through the 9 steps. You pull up again the 1-year chart of SPY, and you say, is it, let's come back here. I can show it quick on my broker platform. You look at the 1-year chart and you ask those same 2 questions. Is it going up and is it still going up? And if it is, you rinse and repeat the 9 steps. If the answer to that question is no, you sit on the sidelines. Okay? So that's that. So that's where we're at now. We are at 20. I am at a 10%, excuse me, a 10%, 10.84% gain on this option contract in less than a month. All right, so let me stop here and look at the question panel and see what questions people are typing in here. And Dwayne says, that's what I hate, the emotional selling and fear. Oh, yeah, Dwayne, definitely. Take some getting used to. You'll hear some people say, oh, be like a robot and things like that. I'm like, really? We're humans. It's no way we can trade like a robot. We can't pretend like we're robots. It's impossible. We're humans. We are emotional creatures. So what I have found is that there are parameters of things you can do. Okay, let's bring this again. Remember I said options is hard to understand unless you bring it to things you understand. Donuts is like my vice. It's things I like. If I have a dozen donuts in the house, I will eat a dozen. That day, by day 2, all of them are gone. Hands down, always happens. Usually I eat about 6 or 7 the first day. Get sick, and I'm like, let me eat the rest in the morning. Okay, but always, no matter, you put a box of donuts in my house, they will be gone within a day, 2 days. Okay, so what do? I recognize I just don't have discipline in that area. We just don't buy donuts. We don't keep them in the house. So did I go to counseling and learn how to develop more discipline, or no? Did I, get an operation on my stomach? No, I said, I don't have discipline. Let me put some parameters in place to protect me. Same thing with emotions. I recognize I'm emotional, so I put parameters in place. So one of the parameters in place is I don't invest a lot of money on my trades. That's one parameter. Other parameters are I don't look at the news. I don't look at my trades during the day. I may take a glance at them during the day to see how they're performing. For the most part, I wait till the market is closed, like right now. I'm not seeing my account go up and down in price. It's constant. The market is closed. There's no emotions. So there are all these little tricks and things you can do to protect yourself. You don't have to get rid of your emotions or anything like that. You can be a complete emotional basket case and still succeed as a trader as long as you can find tricks and parameters to put in place. Another trick and parameter, there's a lot of tips here. I hope people are writing this down or watch the replay. Another trick and parameter I have is that if I come off a huge win, like, again, let's say I got lucky and this SPY trade went up to $30. No, let's say 60. That's outrageous, right? Let's say, and it happens every now and then, 395% return on my investment. If I have a huge win like that, what happens is I get an ego, and I think I'm just hot stuff. I'm like the best trader in the world. And so I get sloppy on my next few trades, or I think I'm just so good and every trade I make is going to be a winner. So what, you already know where this is headed. What generally happens is I wind up losing money or losing all my money. So when I have a huge win like that, what I have found is I take what I call a trading fast, and I literally will stop trading. I will close out my charts. I won't look at the stock market for about a week or so. I won't make any more trades until I feel my ego settle down. You can kind of get a gauge on your emotions and tell when that last winning trade, you don't think about it as much. And when my emotions, I feel like they're kind of settled down back to reality, then I'll start trading again. Because when my ego's in the way, I wind up losing money. So that's a little emotional trick I use. Again, anything in that I say I'm trading like a robot or going to counseling and getting rid of my emotions? No, I recognize I'm an emotional creature, and I just put little tricks or parameters in place to protect me for my own emotions. And that's what I found that works for me. I teach it to my students, and some of the other traders I work with. That's what they do. So let me look at my notes here. Calculating profit and loss. Somebody had a question about calculating profit and loss. I have that formula here. I simplified it because I confused someone initially with the first version. But the purpose of the spreadsheet is so you don't have to calculate it. You can just, again, go to the bid price here and track it on the bid price. All right. What else? Let's see. Somebody had a question here. This one, I guess it was based on something. This one is not really based on the book. If you have any questions based on the book, go ahead and ask them now. If not, we have a few minutes. I have about 5 minutes. I don't want to make this webinar too long because people won't watch it. But about 5 minutes, I can cover some other questions. But I won't be able to cover all of them if there's a ton. But I'll cover as many as I can in the next 5 minutes. But this one, I told, I think it was Rebecca. She says she bought 2 contracts of AON on 2/9/15, and then she paid $421, and the stock was closing at $420, so lower than what she paid, but it was worth $199 in profit. I was scratching my head on this. I don't get that at all. I have Call Your Broker here. Whenever you see stuff like that, definitely contact your broker. Your broker will know more than I. They will see what's wrong with your trading platform. They can explain it. This doesn't make sense to me at all. It may be something wrong with the broker platform. Even when I went here I tried to recreate her scenario. I bought an option here for $420, close to, let's come back here, close to what she said. She bought it for $421. She says on 2/10 it was closing at $420. Well, on 2/10 it showed it was closing at $525, and I show a profit of $105. So 105 is kind of close to her $109 profit she saw. So I'm thinking something was wrong with the broker platform. And that's whenever you have situations like this, you definitely want to contact your broker. They will be able to answer it easier than I will because I can't see what you're doing. Okay? So let me come here and look here at the question panel again. So next question is Dwayne says, how do you keep an eye on everyday income? The problem with, all right, let me try to summarize this. How do I keep an eye on the everyday income problem? So like an example is, let's say you make $1,000 one day, then the next day is negative 500, then the next negative 400. And even though you kind of look at the technicals and all that, it's still all over the place. And I guess how do you resolve that? You shouldn't have, let's see, one way, again, going back to what we said in the beginning, it's called multiple streams of income. My mentor, that's another benefit my mentor was telling me about, how having multiple streams of income. When my options account is fluctuating, I don't have to stress that much because, again, I have another, preferably another stable source of income compensating for the fluctuation. Second thing, though, going back to the emotions, my account doesn't fluctuate that much from 1,000 and negative 500 to 400. If it's fluctuating that much, the one red flag that shows me is investing too much on your trades or having too much your account at one time. I don't like my account fluctuating like that. Again, going back to that emotional basket case thing, that stresses me out. So I don't put myself in a position where my account can fluctuate that much. From 1,000 to negative 500 in one day, that's a 50% swing in price. That has to mean that I have at least 50% of my account out in the stock market. That is just not smart. To me, it's not. So I don't do that. At most, I might see a 5% fluctuation in my account. That I can handle. So that's what I do. I don't invest a lot on my trades. I don't have a lot of my account out at any one time because I don't want to see those fluctuations. I want to see slow and steady gains. I teach a get-rich-quick approach. None of that get-rich-quick, swinging for the fences, trying to get rich like yesterday. None of that. It's really slow and steady. Here, like you see here, I bought one option contract for $1,000. I'm sitting and waiting, and less than a month later is up 10%. That's good for me. You know, that's a profit. I don't need to get greedy and open like 5 more of these trades. I could literally just sit and let this one sit and wait. And then once I close this one out, then I put more money out in the market. But as long as I have 1 or 2 trades out, they're doing pretty good, I'm fine with that. You know, I'm collecting my $100 here, $500 there. It all adds up at the end of the year. You know, a lot of people get stressed and they freak out because they're like, Travis, you know, you have like, let's say I have $10,000. I may at any one time maybe have 500 to 1,000 out in trades, you know, and people are freaking out like 90% of your money is in cash. You know, you could be using that cash and earning more money. And I'm like, yeah, I could be. And I could be losing more money too. And then I pull up my famous secret investing loss formula. And this is why I gave people that money management rule here. I says, get out of the 50%, 40 to 50% loss. And here's why. Because I know this formula by heart. I've seen the downfalls of it. If you have a mutual fund account or option account, stock account, I don't care what account you have, but if all the money in your account, which like in the last market crash, people lost about 50%, 56% of their money, your entire account has to have 100% gain in value just to recoup the loss. That's not even making money. You're just recouping the loss. So that's why I tell people, get out at 40 to 50%, because once you get past 50, your account has to have 150% increase, 233. Now, the question you have to ask yourself, not theory, your brain will tell yourself, oh, with options, I earn 10% in a month, you know, you'll do this. Travis earned 10.84% in less than a month. Let's say he did that every month. In a year, he would double his account and have 130% return on my account. In theory. So in theory, people will look at this and say, well, in theory, I could double my account every year. I read it online. People say you can do it. Well, that's theory. Reality is it's rare I double my account because that's what I'm earning right now. But the market just doesn't go straight up or straight down. And AAL is a perfect example of that. You can see that the market doesn't go straight up or straight down. In the last year, yes, AAL is higher than it was a year ago, but it had some ugliness halfway throughout the year. And so, gosh, where was I going with that? Oh, so anyway, so yeah, in theory, I could double my account, but the reality is I usually come away maybe 30 to 50%. Say, so never convince yourself in theory that you can double your account. Look at your actual results, your past. Say, in the past, what's my performance been? And if you're new to this and you have no past, you have no history, then don't even think you can double your account. At best, just hope you don't lose money. You know, at best, say you can earn about 11%, which I think is pretty easy with options. It's like child play, in my opinion. Of course, that means you're not investing your entire account on your trades. Hope that mini rant made sense. I get so sorry about that. I get really emotional about seeing that. And when people invest too much and they don't really get this. This is why I don't put a lot of my money out in the market, because I really get this formula. Yes, 90% of my money is in cash. But guess what? If I have a $10,000 account, I've only had $1,000 out. That's 10% of my account. If I was to lose all of that, I'm still protected. I still got like $9 grand, and I can live to trade another day, and I only need 11%, gain to recoup that loss. I'm still in a good position versus somebody losing 50% of their money. They've dug such a big of a hole. I promise you, it's going to take 2 to 3 years to make it back. Ask me how I know. So I never even put myself in that position and lose that. All right, so I'll answer the next couple of questions here, and then we will go ahead and get off the call. So what does the I and A stand for in your equation? I stands for income, A is asset. And I don't know if you were here on the beginning of the call. I think that's what you're talking about, the option profit formula. It's just called income and assets. So so when you look at the replay, I'll go over that. I think that's what you're talking about because I don't see any IA anywhere else. Okay, so Brian says, how do I choose any given trade over the next? Do you base your stock choices around the Greeks or any particular fundamentals? Nope, I sure don't. What makes options profit? Options are derivatives. They are derived from a stock. Great question, Brian. Earlier, I told you we looked at 4 stocks. I told you I have my favorites. Apple. Let's look at Apple. This is a 1-year chart of Apple. Let's look at HAR. How do I base my trading decisions? Off the story the stock is telling me. Which chart did I like better? If I had HAR in my retirement account and my family's livelihood, feeding my kids was based off of this stock, it went nowhere all year. And yes, at the end, because of earnings, it had to jump up in price. Whoopee-doo. All year, we made no money. My family was starving. We couldn't eat. It was money tied up, lost opportunity. Didn't do anything. Let's say we invested our wealth in Apple. Apple went up consistently for a year. I like Apple. I like that chart. That's literally how I base my trading decisions. First, off of the stock chart, because stocks, options are derivatives. They're based off the stock. Once I find a stock I like, then I look at the options and all that, which we don't have time to go over, what options to pick and all that. That's my simplified approach as to, how I pick my options. All right. So I think I have one more question we can squeeze in here. Buy and hold. Michael, I don't believe in buy and hold. He says, are these buy and hold trades? I don't believe in buy and hold. I think buy and hold is a scam. I like the term buy and manage. I don't buy and hold anything. I buy and manage my trades. So slight twist, but I am holding this particular trade for this book. Yeah, we're holding for the long term because it will take a while for your exit criteria to be hit. Not 50 to 100% gain range or the 40 to 50% loss. So it will take a while to hit that. So, technically they're longer term trades, but they're definitely not buy and hold. We will manage these. Dwayne says, do I still use Market Club? Absolutely. Definitely. I'd sing nothing but praises about that software because it's so accurate. It just helped us make a lot of money. So definitely I keep using it. All right. And last question. So Brian says, basically, I am using directional options mainly. No, not entirely. I think one of the benefits in the beginning of the call, I don't think I said you can, with options, you can make money when stocks go up, down, or nowhere in price. USO is a stock that for the last 5 years has gone nowhere. I think 2013 I traded this. Stock went nowhere. It wasn't directional. And I think I made about 17% off of it using some option strategies. So I don't purely use directional. Directionals, I'm mainly a directional trader. Yes, 90% of my trades are directional. I'm just where I'm best at. But no, every now and then I'll find a stock like this that's going nowhere, and it's predictably going nowhere. And when it's predictably going nowhere, that's a caveat. It has to be predictable. And because it was so predictable, jumping up and down between these two lines, I was able to use an option strategy that allows you to make money when stocks go nowhere in price. And so in that year, I made 17% off of a stock that went nowhere in price. It was flipping amazing. And I was able to record that for the students of the Success Academy. All right, so that's it. So I thank you again for everybody for your time tonight. Time is your most valuable asset, so I am completely honored that you spent it tonight, allowing me to walk you through my first book here. And, again, I'm like any new author, I'm a little nervous here, what people think, but I'm excited to finally get this book out to everybody. And I can't wait to write the next few series. So I will have this replay out to you 48 hours after this call. It will be posted to this website right beside this video. I will send a link to this website when that replay is ready. So you all take care. Have a great rest of your week, and I'll talk to you soon. All right. Bye-bye.